In the world of business, profit is a theory, but cash is a fact. You can have a mountain of sales and a warehouse full of inventory, but if you can't pay your electric bill or your employees on Friday, your business is a ghost. To see the truth behind the curtain, we look at the most honest document in finance, the cash flow statement. This isn't about what you hope to get or what you've promised to pay. This is about the actual green, the cold, hard cash flowing into and out of your bank account. Many people assume that if a company's income statement shows $1 million in profit, they have $1 million in the bank. This is a dangerous misconception. Thanks to accrual accounting, a business records a sale the moment a contract is signed, even if the customer won't pay for 90 days. The cash flow statement bridges this gap. It strips away the accounting magic and shows us exactly how much liquidity a company actually has. It answers the ultimate question: is this business sustainable?
To make sense of the movement, we categorize every dollar into one of three buckets: operating activities, investing activities, and financing activities. Let's break down the big three. Cash flow from operating activities, CFO. This is the most important section. It represents the cash generated by the company's core business. For a bakery, it's selling bread. For a software company, it's subscriptions. If this number is consistently negative, the business is burning cash just to exist. Investors look here first because it tells them if the company's engine is actually running or if it's just coasting on borrowed time. Cash flow from investing activities, CFI. This section tracks the cash spent on the company's future. It involves big-ticket items, buying equipment, purchasing real estate, or acquiring other businesses. Interestingly, a negative number here is often a good sign. It means the company is reinvesting in itself to grow. However, if a company is constantly selling off its equipment just to keep the lights on, this section will show a positive flow that hides a grim reality. Cash flow from financing activities, CFF. This is where the company gets its external fuel. It records cash moving between the company and its owners or creditors. When a company borrows $1 million, their cash goes up, but they haven't earned it. The CFF section makes sure we don't confuse a bank loan with business success. At the bottom of the statement, we add the three sections together to find the net increase or decrease in cash. We then add this to the cash we had at the start of the period. The final number must match the cash line item on the balance sheet. If it doesn't, the accountants have a long night ahead of them. How do we interpret these numbers? Let's look at three different types of companies. The healthy giant, positive operating cash, negative investing cash, they are growing, and negative financing cash. They are paying back debt or giving dividends to shareholders. This is the gold standard. The hungry startup, negative operating cash, still finding their feet, negative investing cash, buying tech or offices, and heavy positive financing cash. Investors and banks are pouring money in. This is a race against time. The sinking ship, negative operating cash, positive investing cash, selling off furniture and equipment to survive, and positive financing cash, taking on desperate loans. This is a red alert. Most companies use the indirect method to report cash flow. They start with net income from the income statement and then adjust it. They add back non-cash expenses like depreciation. Since no one actually wrote a check for depreciation this month, that money is still in the bank. Then they subtract money that is trapped in accounts receivable. If a customer owes you $5,000, you have the profit, but you don't have the cash yet. This section fixes the profit number until it reflects reality. Cash flow is the ultimate truth teller. It's what pays the bills, funds the research for the next big invention, and provides security for thousands of families. When you learn to read a cash flow statement, you stop looking at business as a series of abstract goals and start seeing it as a living, breathing organism that needs a constant, healthy circulation of green to survive and thrive. So the next time you hear a company is profitable, ask one more question. But how's the cash flow? Because in the end, cash isn't just king, it's the entire kingdom.